The tariffs are here, and they're about to reshape the entire retail landscape in ways you might not have even realized. Retailers are now staring down rising costs, broken supply chains, and no easy fix. Yesterday, on April 2nd, the Trump administration unleashed a new set of sweeping tariffs aimed at almost every country that the US trades with. Stock markets across the globe immediately tanked in reaction to these, and now we're dealing with the devastating consequences of these policies. So in this video, we're going to dive into the real-world impact behind these tariffs, and in particular, how it's going to hit retail apparel companies like Nike, Adidas, Lululemon, and a couple others. But we'll also touch on one of the biggest retailers in the world, which is going to get crushed here, as some of the companies have seen their stocks decline by over 10% in just under 24 hours. So first, what exactly are these new tariffs? Well, the plan includes a 10% blanket tariff on all imports to the US, but then there's also reciprocal tariffs slapped onto countries that have tariffs against US goods. So in short, it's a show. China's tariffs alone went up to 54%, and Vietnam's went up to 46%. While countries like Mexico and Canada were technically spared in this round, they still have the 25% tariff that was in place from a month ago. Now, why does this matter for retailers? Well, frankly, it changes everything for them.
President Trump's tariff announcement is what Jeffrey's team in Asia calls, quote, a nightmare come true for textile and footwear manufacturers.
According to Jeffrey's, only about 1% of US footwear and 2.5% of clothing is made domestically in the US. The first and most obvious consequence of these tariffs is that everything is about to get more expensive. And currently, Nike's stock price is down 13% today. That's because Nike sources a huge percentage of its products from countries like China and Vietnam, which means that sneakers, sportswear, and athleisure are all about to face higher production costs. When production costs go up, prices go up. So unless Nike can magically rebuild its supply chain overnight, which it can't, your next pair of sneakers or workout gear is definitely about to get a lot more expensive. Nike can't just absorb these costs completely, even if they try to absorb some of it. Nike's profit margin over the last few years has ranged from 13% on the high end to 9.5% on the low end. If all of a sudden Nike's goods cost 40 to 50% more due to tariffs, this isn't just a simple price hike for them, it's an all-out crisis. And for Nike in particular, this couldn't come at a worse time. The company has struggled over the last few years, facing declining North American sales, inventory problems, and stiff competition from other brands like Hoka, On Running, and even New Balance. Just a couple months ago, Nike brought in a new CEO to help turn things around after years of declining performance. Investors were hopeful that Nike could stage a comeback, maybe even pull off a turnaround story. But with these tariffs looming, and if they're going to stay in place, well, that optimism is fading fast. Nike is already being forced to cut costs and restructure, and this latest blow could force them into even more drastic moves. This will probably mean layoffs, certainly price hikes, and also maybe even a shift in strategy, none of which are ideal for a company that's already struggling to find its footing. But Nike isn't alone. Adidas, despite being headquartered over in Germany, also has a massive presence in the US market and relies heavily on factories in China and Vietnam. Like Nike, Adidas faces significantly higher costs from these tariffs, potentially leading to similar price hikes and supply chain disruptions. This illustrates just how broad and far-reaching the impact of these tariffs truly is. It's not just about American companies at risk, but rather global companies tied to the global economy. But another giant in the sportswear market that's getting hammered today is Lululemon. Their stock is currently down over 10%, and Lulu has already had a rough year, with its stock going down 27% in the past month. While the company did report decent earnings in its latest call, the outlook for future growth had investors spooked. And this came well before Trump's new tariff plan was announced. So today, this plan threatens to add even more pressure onto this company. Lulu sources a significant portion of its products from Vietnam, Cambodia, and Sri Lanka. While they do also have some business in China, countries that could face higher tariffs under Trump's policies are all being hit. Shifting production isn't as simple as flipping a switch, meaning the brand could be stuck with higher costs for years. And while you might not care exclusively about Lululemon, this sort of thing is true for so many companies. And I know a lot of people want to say, well, good, bring American jobs back here. It's just not that simple. And I've covered that in previous videos, but I hope people aren't just thinking that all of a sudden these manufacturing jobs will just flood back to the US. It's not going to happen. But back to Lululemon. Competitors have been eating away at their market share for the last couple years, and cheaper brands may try to capitalize on any consumer hesitation that is shown. If the price hikes are too much, all of this could come at a time when Lulu's trying to expand internationally and navigate shifting fashion trends. And the last thing it really needs is a policy that forces price hikes and disrupts its supply chain. Now, I want to talk about what's probably the most important aspect to this whole video. All of these companies currently don't know what to do. They have been in limbo since the idea of these tariffs were floated, but they didn't really have any clear answers as to what they were going to be and where they maybe should shift their production to. I mean, none of it. Then all of a sudden, boom, it's announced. And today, they still not only have to worry about these tariffs, but also the uncertainty that comes with them, because the administration has talked about a few different reasons as to why they're doing this, all of which are sort of in tension with one another. They've talked about how it will increase revenue for the country. Then they've talked about using these to bring other countries to the table so that they can negotiate fairer trade. And they've also talked about the reason they're doing this for certain countries is because of fentanyl. There are so many reasons here, it's hard to kind of keep up. And so all of these companies have to wait and see, like, is this actually real? Because these decisions to shift supply chains and change their suppliers or manufacturers all take significant investments of time and money. You don't just do it on a dime, but you also don't do it if the reason for making this decision could be reverted in a week or a month. Now, as it stands today, this is currently the biggest tax increase in US history for consumers. And it's not just clothing brands feeling the pain, okay? Let's talk about Apple. One of the largest and most recognizable brands globally is caught squarely in the middle of this firestorm. Apple's stock price also took a sharp hit today, down 10%, as investors scrambled to assess the damage. It lost $311 billion in market value and had its worst single day decline since March 16, 2020, when the COVID pandemic triggered a wide sell-off in the stock market. Apple is so vulnerable because virtually every iPhone, MacBook, and iPad is assembled overseas, primarily in China, and increasingly in Vietnam and India. So with these new tariffs, Apple obviously faces skyrocketing costs that could force price hikes on nearly every product in its lineup. This is coming at a time when Apple is experiencing slower sales in some of its hardware segments, including the iPhone. Now, some investors have speculated Apple could negotiate a carve-out with the government. Due to its enormous influence and lobbying power, they may be able to not be hit by these tariffs. But given the broad and confrontational approach of this current plan, right now that seems unlikely. So if Apple doesn't receive special treatment, the ripple effects could be dramatic. Higher priced phones, MacBooks, AirPods, all of it. This could all lead to consumer hesitation, leading to a slowdown in sales, threatening Apple's famously high margins. And that scenario would put the tech giant's earnings and long-term growth at serious risk, sending shockwaves through the tech industry and impacting millions of people who are directly or indirectly invested in the company, as currently today it's the largest company in the world by market cap. Now, I also want to mention how top US brands like Nike, Apple, and so many more have spent years strategically shifting away from Chinese factories, anticipating prolonged trade tensions between Washington and Beijing. So countries like Vietnam, Cambodia, India, and Indonesia became the preferred manufacturing hubs for some companies, offering somewhat of a safe haven, at least until now. As BMO Capital Markets analyst Simeon Siegel put it, companies that worked hard over the years to reduce reliance on China by leaning into countries like Vietnam just learned that there really isn't a place to hide. Suddenly, what seemed like strategic foresight, moving supply chains away from China, has now become another liability, leaving retailers scrambling to find new suppliers in regions unaffected by these tariffs or who will unlikely be affected in the future. Now, the cost of these price hikes will have ripple effects in other areas that you may not have considered. And I understand some of you may not care about higher prices for things you don't really use or clothing brands you don't wear, which I understand. But when major companies across multiple sectors of the economy start to struggle due to these higher costs, it weakens demand. And when demand weakens, companies lay off employees, leading to unemployment and then less consumer spending. This also affects the stock market, and even if you don't directly invest into these companies, This currently is a market-wide deal, not just a sector-wide. Nonetheless, your 401k or any retirement funds end up getting hit. All of these downstream effects are critical to our economy, and none of them are really helpful for employment, wages, wealth, or really any form of financial security. And to top it all off, they don't bring prices down, which is what this administration said they were going to do. Oh, and there's also this impact, which I think this economist put very well.
We've estimated that the revenue raised by these tariffs in 2025, if they're all left in place, will be about $290 billion. That's a lot lower than what you might hear elsewhere. That's because when we put a tax on imports, imports fall. If you think imports are going to stay the same, you're out of step with the economic literature. We also know that when tariff payments rise, other tax revenues fall. Tariffs, like I mentioned, pull income out of the economy before it's actually sent to workers or to shareholders. So it shrinks the bases of the income tax and the payroll tax, cutting off some of the direct tariff revenue. That's what gets us down to that $290 billion. And on average, that amounts to a tax increase of more than $2,100 per U.S. household, or a reduction in after-tax income of more than 2%. It hits lower income households and middle income households, so working class people, harder than it does wealthier people, because lower income households consume more of their income than the wealthy do. So this is a regressive tax increase, even if it's used to partially offset something like, let's say, the Tax Cuts and Jobs Act extension. About the bottom 80% of taxpayers are worse off under that trade, because the tariffs are a larger tax hike on them than the tax cuts will provide a benefit.
In the end, what we're seeing here is the largest tax hike in US history, and it's coming at the worst possible time. These tariffs will hurt retailers, raise prices for consumers, and slow down the economy as a whole. The real question is, how much will consumers continue to spend when everything gets more expensive? It's hard to see how this plan will benefit anyone except the politicians who are pushing it and probably hoping to score some short-term political points without thinking through the long-term consequences. As consumers, we're about to face the painful reality of higher prices at every turn. For some retailers, it's going to be a battle for survival, and not all of them will make it through unscathed. Now, if you enjoyed this video and you want to learn about how tariffs will affect the auto industry, well, I covered it in this video here, so go ahead and check it out next. Thanks for watching.